Hello, this is Dean Malone with Compass FX. Hope you're doing well today and again some good trades. Today I want to show a quick little trick for those of y'all who are scalpers and aggressive traders in this range-bound market that we're in. The market's been up and down, and for those of y'all following the synergy trading model, you might have been taken out based upon some of the trading rules. I've recently received some comments from traders saying, Dean, I'm following the Traders Dynamic Index and the techniques that you talk about with the synergy trading model, but I'm getting knocked out because the market's up and down, up and down. Now, as you know, traders look for uptrends and downtrends. Uptrends are signified by higher lows. The downtrends are indicated by lower highs. However, as the market attempts to make higher lows, it sometimes will pop up a little bit and fall back down and knock a trader out of position, or it'll move tightly within a range and knock you out as you're attempting to stay in that uptrend. Same thing goes for a downtrend. So what I want to do today is show a quick little trick that you can do with the Traders Dynamic Index to help you get that confirmation of potentially staying the trade a bit longer. It doesn't necessarily mean you're going to make a lot more pips, but there's the chance that you could ride the uptrend a little bit longer and ride that downtrend a little bit longer for more pips. Let's take a look at what I'm talking about here. As you can see, we have this uptrend, but the market's been up and down, up and down. You see the higher lows right here, and then the market made a bit of a punch, a low, then a lower low, but it's still higher than what we have back here. Market punches up a little bit more, low, then a higher low, then another low. One of the things that I talk about with the Traders Dynamic Index is when you look to enter and exit a trade based upon the Traders Dynamic Index rules is simply when the green crosses over red to the upside, that's an entry. When the green crosses below the red, that's a potential exit there. However, as you can see, you'd be in, out, in, out, in, out in this choppy market condition. Same thing goes with this downtrend. Nice move down, like so. The market pulls back up, chops around a bit, shows a potential entry as it crosses back below, then back up again, knocking you out of a trade, then rolls back again, and you get chopped around trying to stay in this downtrend. Well, let me show you this simple technique. You go into the Traders Dynamic Index, placing your cursor either on the green line or on the red line, right-click, go to the Traders Dynamic Index, simply click on that, and go up to the trade signal line to the red here, double left click, and you get this pull down. In the pull down, simply choose none. What we're going to do is we're going to, in effect, remove the trade signal line or just take the color away, and that way, when we click OK, there's not a red line there. So when you're trading on these lower time frame charts, if you notice I'm on a euro-dollar 5-minute chart, up here it states it right there, euro-dollar 5-minute chart. When you're on these small time frame charts, to avoid being knocked in and out, in and out, in and out of positions, then what you're looking to do is enter a trade as the green line crosses the yellow and look to exit as the green line crosses back over the yellow. Now, one key point here is you want to look for the close on the other side, because sometimes what you're going to have happen is the green line is going to come real close to the yellow like it did here and then bounce and go back in the direction in which it was originally going. So in this case we have 1, 2, we got 3 bounces, then we finally have a close on the other side here. So from this standpoint, we get an entry somewhere in this area right here. Then eventually we get an exit back in this area. Not much of a trade right there, maybe anywhere from 4 to 8 pips there, less the spread, but from a scalper's point of view, 2 to 8 pips, not bad. But the fact of the matter is, you could have held in there through this up and down right here, and when it made its big push, you could have scaled out some with more pips in the trade. Let's take a look at another example here. Crossing here, and we'll just go off the high right there, and eventually we get a cross of the green and yellow right here, down at this low point here. That's about 13 pips, less the spread. Not too shabby for a scalp trade. Let's take a look at this downtrend right here. Now, you have to understand too that as the market makes a move, it's going to go through periods of consolidation, where there's profit taking, and then do we have continuation of the move or not. So in effect, the market moved down right here, then pushed back up for profit taking, bounced around bulls and bears, kind of tug of war here, and then we follow with lower highs. Now notice down below here, removing the red line, we could have held in that trade. From this point right here, let's say we entered on the low right there. There's the low. The low's sitting there at 32.50. And then right here, again, the crossover right here in the close, this closed at 32.12. So at 32.12, we would have had about a 35 pip trade in this area. Even at the high right there, if we exit the high, a 35 pip trade less our spread. Not too shabby. So in order to avoid some of the in and out chop that some scalpers and aggressive traders experience trading the synergy model following the trader's dynamic index entry and exit conditions, again, simply remove the red line. Follow the green line crossing over the yellow line. Look for the market to close before making the assumption that the market's going the other way, because sometimes the market's going to take a bounce here. Let me show you one more time. Here on the Euro Yen, you can see a lot of back and forth going on right here. However, if I simply go to the red line, right click, select Trader's Dynamic Index, go up here to the trade signal line, the red, double left click, choose none, click OK. We have a similar situation. Market crossed over right here. Then it closed back over here. That trade right there might have been flat. Okay, if you look from high to low, flat trade, maybe a small loss. But then check out this trade. Cross here. Exit. Looks like to be, I'll call that low right there. 17 pips less the spread. Same thing over here. We get a trade right about here. I'll go off the low. You stay in it because it didn't cross the yellow. Comes all the way down. Then we get this final cross right here. Even if you exit on the high right there, there's a 38 pip trade, less spread, not too shabby for an aggressive scalper type trader. Well, folks, this is Dean Malone with CompositeFX. Hope some of the information I've shared with you here about a technique to help you stay the uptrend or potentially stay the downtrend when the market's chopping around on these smaller time frame charts, 5 minute and lower, will help you out in your trading. You might also consider this used on a 15-minute chart, especially when the market's range bound as it has been as of late. Well, folks, y'all make it a great day. Get some good trades. We'll talk to you next time. Bye-bye.